everyone, and welcome to this episode of the Ncast from Ncontracts. I'm Guy Weissman with Ncontracts. First of all, can't thank you all enough for supporting the podcast. We really appreciate all the feedback that you're giving us, so please make sure to keep it coming. You know, I think we'd all agree that there's no topic that's dominated our lives, both personally and professionally this year, like COVID. And so today we're going to dig into the numbers a little bit. Recently, there was a survey published, and the title of that survey was Banking After COVID-19, and the findings are pretty compelling. So on today's episode, we're going to hear from the co-author of that survey, Ron Balmer. He's with Greenwich Associates. And he's going to talk about how organizations are adapting to become more agile when it comes to risk and compliance, as well as how the human factor figures into this, how we all do, and how humans are going to remain a key asset to any financial institution for this foreseeable future. Something I know we're all glad about, right? So I'm excited for this episode, and I'm also excited for what Ron has to share with us all. So let's get into it.
Ron, welcome to Ncast, our podcast. We are excited to have you on the show. How are you?
Thank you. I'm well. I'm glad to be here.
We were talking before we hit record that we have known each other for over 30 years, not in banking, but it still is kind of remarkable that we ended up working in the same space.
Yeah, it is a head shaker, that's for sure, but it's been great. And I'm so glad to be able to talk to you about this, but to be able to talk to you in general.
Yes. Same. So we both ended up in the banking industry. Just can you talk a little bit about how you made it to the banking space and especially to Greenwich?
Sure. I'm an accidental banker. And I'm actually not even a banker. I consult to banks and provide sort of strategic advisory services for banks. Way back when I worked in the world of politics, and that got me recruited to the Forbes organization, and that got me recruited to the Gallup organization, the huge polling company. At Gallup, I discovered quickly that all the money was on the consulting side of the house, not on the polling side of the house. So I made the change to do that to, just sort of improve the quality of my life from a financial perspective. And along the way at Gallup, I competed with Greenwich for some business. And in doing so, I won some and I lost some. And that's how I met the leadership of Greenwich Associates. And I would say maybe midway through my Gallup years, they said, if you ever want to make a change, we'd love to find a spot for you.
Right. And
it wasn't right at the time. And then when it was right, I picked up the phone and called them, and I've been here now for 13 years. And so Greenwich Associates, 48 years serving financial services companies only. So my clients are banks and financial services companies globally. And as I say, for 13 years, I've been serving them, in strategic advisory, research, analysis, stuff like that.
Right. And I know Greenwich was known for having a strong research arm. So that really makes for a nice segue for what we're going to talk about today, which is a paper that came out in the fall, Banking After COVID-19. And
Right.
Just to kind of set the stage for what we're going to talk about, some of the key areas that the report addresses are a baseline accounting of where the banking industry stood in the final quarter of 2020 in terms of revenue and clients, how to use digital technology and data to enhance the value they provide to clients and investors, and the long-term future of the banking industry. And I think everybody's probably doing some soul searching right now on how to tweak or significantly adjust their business model.
Right.
So we're going to kind of dive in. And I know that you were part of the team that created this paper. What were some of your aha takeaways?
Well, I think probably the biggest aha takeaway for our clients is that the human touch is not gone. It still matters. I think you could misread the data if you were looking at the data in a vacuum and thinking through the impact of digitization and the impact of sales and service models having to go online because of COVID-19 and the inability to meet with clients face to face. I think too, you would misread it if you fail to understand that clients are not voluntarily moving to digital media and mediums for interacting with banks and bankers, it's mandatory. And so for us, the data revealed that it really is this model of serving and supporting clients, while different, is not really the new normal. It's a temporary normal, because clients tell us when we ask them, the buyers and consumers of financial services tell us they expect to see their banker in person. Many of them said they hope to see their banker in person in Q4 of 2020 and in Q1 of 2021. I think that is a surprise for many people who think that this kind of digital way of selling and serving is going to be normal. It was the human touch that separated the banks that succeeded from those that did not. When we talk to people about PPP and the experience around Main Street lending and the PPP loan process, it was the banks that had the human touch, the banker, the person in the front office, the person in the middle office, the person in the back office, who delivered the sense of caring and the empathy, and were there on a Sunday night working through the night so that you'd have your application in on time on Monday morning. That's people. And so I think that's probably the biggest insight and aha, is that we're going to need to strike a balance between digital capabilities, digitization, online sales and service with the human touch.
Right. So the report also said one of the aha moments that it had outlined was the organizational agility.
Yeah.
Can you talk about that a little bit?
Sure. I mean, the whole COVID-19 was such a shock, and the impact on people was really profound. And something we've said as a firm for many years is, banking gets kind of a bad rap as being considered dry or boring, or entirely populated by people who are risk averse and what have you. And what we find is that that's really not the case. Banks are critical and integral to people's lives. If you hold my small business loan and I provide for my family from that small business, you are in fact an emotional part of my ability to reach my goals and objectives and serve my family. You're an integral part of the community. And what banks did through the crisis really helped communities survive and helped people worried about their mortgages, their credit cards, their finances, their financial futures. And that emotional relationship with customers is such an important consideration that I think that this whole exercise that we've been through really helped illuminate that for a lot of bankers.
Right. That's fantastic. So, as you may have guessed, our audience is predominantly risk and compliance officers. And the report notes that the digital transformation journey of addressing those client needs, because there has been such organizational agility. I know I was pleasantly surprised to see a call out for risk assessment tools with insights.
Yeah.
And a sentence in the report that I'm going to read real quick. One of the biggest sources of ROI on technology investments is back office and other process automation that creates efficiencies, lower costs, and enhances margins.
Right.
I'm really curious to hear you speak to that.
Yeah, so that is, I think, a natural byproduct of digitization. When we think about and prioritize what we're going to digitize and make automated, it's almost always something that replaces forms and paperwork and duplication. So that means you've got onboarding, e-signatures, a lot of those back of the house processing, auto-populating forms and documents, things like that. Those came first. And those removed really a frustration or a pain point from a client, while also delivering on efficiency for a bank. Global transaction banking revenues were steadily climbing year in and year out since 2012, except for 2020, where they're taking about a 6 to 8% hit. So the fees that banks are generating from transactions are in a decline of about 6%. We think they're going to increase in 2021 by as much as 8%, sort of a bounce back. But for 2020, banks are really challenged in terms of the ability to generate revenue off of fees. At the same time, customers got accustomed to banks lowering fees, waiving fees, providing certain transaction banking or treasury management activities at no cost, because the banks were betting on making the revenue on the interest income and on the margin side. That's the spreads. But with those spreads shrinking and net interest income in decline, it's our view that the future of banking means customers are going to have to make peace with the fact that their banks are going to start charging them fees again and stop waiving fees, because banks are going to be pressured to do that to generate fee income.
Right.
In that environment, generating or realizing margin growth by improving processes and systems through digitization will grow in importance and will become a greater priority for institutions that haven't done it already. And as that happens, we think that ROI on that investment in digitization is only going to increase.
That's fantastic. And of course, I want to say that no report would be complete without looking into the crystal ball of the future and what those trends are in store. I know that this report, spoiler alert for those who have not read the report before seeing the podcast, is the new normal economics for cash management, the partnerships with fintech or co-opetition with fintech, and rethinking the client engagement model, which I know is a particular focus in your advisory services. So I'm curious about the second one, but I am kind of curious overall from your research team, what other insights they might have gleaned as far as what you could project for the future.
Yeah, of those three things, we sort of talked about the first one and the third one. The first one being the continued pressure on fee income for global transaction banking revenues, and the third one being the client engagement model to not over pivot or swing the pendulum too far to reliance solely on online and digital means for sales and service, but rather strike a balance between the ability to engage with a client using human assets to drive relationships, while at the same time relying on technology to drive margins and efficiency and speed. It's striking that balance. So that's number one. And number three. Number two, as you mentioned, is the role of fintechs. I remember when we first began to see fintechs rise as a competitor to banks, so many banks were threatened or are threatened by them. And in fact, in PPP during COVID is a great example. We found that some people received their PPP loans from non-banks, and the federal government was recognizing and encouraging those non-banks to play a role in getting that funding out into the market in order to maximize the number of people who were providing that liquidity and the number of sources that people could go to. So people were going to non-traditional lenders to gain access to PPP, and some of them were fintechs. And so there is a certain, at the early stages, it was really competition. And then you had some early adopters like BBVA, Compass Bank, Citibank, and some others who developed partnerships with providers so that fintech provider could do what it did well, while the bank could do what it did well, and come together with a solution that both could be relying upon. Zelle is a great example. Zelle is an expert in creating end-to-end, real-time money movement, and banks didn't want to invest in developing that technology, so instead offer Zelle through your banking platform. Boom, you've got a solution. That's what we mean by co-opetition, or by partnering with fintechs, rather than just viewing fintechs as a competitor. Smart banks are understanding that there are strengths in some of those providers that they should access, and fintechs are beginning to learn that there are strengths in banks that they should begin to access. And those include distribution, that is sales. They include profitability because they have access to customers and clients, and those are things that a lot of fintechs and startups lack.
That's great. So we are getting close to running out of time. Is there a next report based on the findings of this report? Like, was there enough that you found intriguing in a post-COVID world? Because we will pass COVID someday.
Yes.
Were there nuggets of what you want to explore for the next For the next paper?
Yes, we want to explore, if your listeners access the paper, and I hope they will, and they get to the section on client engagement, they're going to find that we talk about the next phase of banks trying to emulate Amazon, Uber, Zappos, that kind of thing. You know, if you think about it, I can drop you in Shanghai where you don't speak the language. You can grab your phone, you can get on it, and you can get a ride from there to your hotel. It'll tell you the make and color and model of the car coming to get you, the name of the person, their photograph, all of their previous ratings, and where they are on the corner of Elm and Maple Streets and how many minutes it'll take for them to get you. That you can do that today. Well, in that environment, customers of banks are saying, if I can do that in Shanghai, why can't you tell me when my loan will close? That's a fair question. And as we get to greater digitization and greater automation, the ability to generate insights from that digital knowledge base that a bank has at its core, that will allow them to anticipate needs, improve communication, improve speed, and be more like an Uber and meeting those expectations that customers have in this digital age. And that's really the next piece. You'll see more from us on that as we begin to explore it and uncover best practices and banks that are already at the leading edge of that, bumping up against the edge of what's possible. 1 and 2, you'll see more from us on the subject of digital investment prioritization. There is a lot you could digitize, and you could break the bank. And if you're a bank of a certain size, you're not going to replicate the investments that Wells and Bank of America and Chase are going to make in this, because you can't. You're going to be a fast follower. Okay, what should you do first? Who should you partner with? How can you white label? Things like that. We'll be talking a lot about that in the coming, say, 14 or 15 months.
Well, I'm just going to have to ask you back onto our podcast to be a guest.
My pleasure.
Banking after COVID-19, we will include a link with this podcast. Ron, it was a pleasure as always. Thank you.
Pleasure's mine. All the best.
Okay, everyone, that wraps up another great episode of the Ncast. You know, if you like what you heard, we'd love it if you would leave us a review and let us know. And if you're not yet subscribed, you can do so on your favorite podcasting platform. We're all over the place. And if you're looking for more information on the survey that Ron was talking about in today's episode, please head into the show notes where we've got a link to that survey, or also on Ncontracts.com. Head over to the podcast page and we have all the information you need there, as well as information on past episodes as well. Thanks for listening, and we'll talk to you all next week.